Take a fixed amount of money, split it down the middle, and send it down two entirely different paths. One path demands your weekends and your willingness to unclog toilets at midnight. The other asks for the stomach to watch your life savings drop 30% in a single month. Jake and Marcus are starting from the same baseline. Both are the same age, earn $55,000 a year, and have exactly $50,000 saved up. Jake uses his $50,000 as a 20% down payment on a $250,000 rental house. He secures a tenant and drives past the property thinking, "I own that." It feels real, tangible, and smart. Marcus drops his $50,000 into a total stock market index fund. He sets up an automatic contribution of $300 a month and goes back to his life. He has no leverage, no tenants, and no keys. At dinner parties, Jake has a physical asset and a story to tell. Marcus has a boring confirmation email. The social proof makes Jake feel like he's winning by a mile. Projecting these paths forward 20 years reveals a striking result. Marcus's compounding portfolio reaches over $400,000. Jake's property appreciation and mortgage paydown land his equity in the same $400,000 to $500,000 range, two divergent strategies leading to nearly identical wealth. Since the long-term mathematical outcomes are so similar, the real decision is about which currency you want to pay with along the way: unpaid physical labor or extreme psychological volatility. This waterfall chart breaks down the real estate dream. Over 3 years, Jake collects $65,000 in rent. Subtracting his mortgage leaves $17,000 in apparent profit. Property taxes and insurance immediately take $4,500. Then a water heater fails and a leaking roof requires $2,800 in repairs. Vacancy costs $1,800 in lost rent, plus hundreds to clean. Ultimately, Jake's $17,000 expected cash flow shrinks to a net profit of maybe $4,000. Jake only kept that small margin because he managed the property himself. He handled the midnight phone calls and the weekend showings, instead of paying a management fee that would have wiped out his remaining profit. Real estate cash flow often functions as a temporary surplus that merely delays the bill from major future repairs. Keeping the investment afloat requires constant physical labor. By year 7, Marcus's growth feels boring and slow. He has no key in his pocket and no asset he can point to from his car window. But the math of his passive approach is working. His $50,000 start plus $300 a month at a 10% average return creates an exponential curve. Eventually, the gains on Marcus's gains generate more new wealth each year than his actual monthly contributions. Scaling this wealth is easy. Increasing a monthly contribution by just $200 exponentially multiplies the final result without requiring extra effort. Real estate scales differently. Doubling an investment requires buying a second house, getting another mortgage, and doubling your physical workload. Index funds offer absolute passivity and total liquidity. They uncouple your wealth creation from your personal time. The price of that passivity is enduring extreme psychological volatility. Surviving a market crash feels like a free fall into total uncertainty. In March 2020, index funds plummeted 34% in a single month. Watching $150,000 evaporate down to $95,000 in a few weeks is gut-wrenching. Many retail investors panic and sell at the bottom, locking their losses instead of waiting for the recovery. Index funds demand zero physical labor, but they required the emotional endurance to survive sudden, massive wealth destruction. Real estate's primary advantage over the stock market is leverage. This 5-to-1 ratio is Jake's secret weapon. He used $50,000 to control a $250,000 asset. When the house appreciates, Jake captures the growth on the full value, multiplying his effective return. Jake also has access to legal tax shelters like depreciation. He can deduct the theoretical decline in his building's value from his taxable income, even while the property is actually appreciating. Real estate wins definitively in specific scenarios, like markets where rent is 1% of the price, or house hacking strategies that reduce your own living costs to zero. Ultimately, a rental property is a tax-advantaged small business, provided you are willing to take on localized debt to fuel it. After 20 years, Jake has a paid-off house worth $500,000 and modest cash flow. He earned it through decades of labor and repairs. Marcus has an identical liquid portfolio worth $460,000. He built it through compounding without a single emergency phone call. Your choice depends entirely on your lifestyle and risk tolerance. Choose real estate if you want maximum leverage and tax benefits, trading your weekends to actively build a business. Choose index funds if you prioritize time freedom, trusting long-term math over short-term crashes. Avoid committing to a 20-year investment vehicle based on a headline. If you don't run the full numbers for your specific life situation, you are walking into a trap.